All right, welcome in, guys. It's another week here, and we have a little bit of macro updates. Also, I'm starting to kind of piece together my thesis on what Donald Trump is doing with markets. This past weekend, I was doing a little bit of just thinking, reading the research reports, all the things that come up on this flow here, which has been kind of interesting. And I think, he's pretty smart. He's playing a longer game here. I know majority of America is probably thinking now, holy shit, this guy is like wrecking the markets. He's, doing this trade war and whatnot. But I think the main thing that he's after is expansion of money to M2 money supply, which the only way that happens is if he can force some kind of economic deterioration, which then encourages the Fed to speed up the quantitative easing process. This is obviously just a working theory and purely for entertainment purpose. Remember that none of what I'm saying is actually real. I'm just giving you my theory on what I think is happening. But it wouldn't be a bad idea to think of the president sitting in the White House, hoping that he could instill fear in, the Fed's eyes and then cause them to, kind of go into a defense mode by then doing quantitative easing. And obviously, there are a variety of different things here that come into play, which I'll write about once I get back to my desk day after tomorrow. But right off the top of this week's Prime Book Report, you can see hedge funds sold macro products and also increased their ETF shorts by 5.4% in the Prime Book. Largest increase in 2 months, led by shorting large cap and small cap equities. Now, remember that this is showing you after the fact. So you don't need to take this to pure weightage because, they could have easily reversed their short sales. You do not know. But this is what they were doing this past week, is what you know. Also, if you look at the subsector level, you'll see that everything except for biotech were net sold, which makes sense. The whole market was melting down. And healthcare is still the most net bought on the Prime Book year to date. Okay, behind infotech, which is behind tech. So you can see there is a healthcare tech rotation going on. Now, I'll get into the deeper granular view of the sectors in a second here, but let's just look at the other stuff that's here. So as we go through our chart every single week, you can see utilities, 5-day net flow, very bad. Also, in general, all US equities bad, macro products bad. Healthcare, energy, the ones that saw the most inflow in the past 20 days was actually materials. Just majority of your copper inflow, your other materials. Infotech also not that bad, actually, all things considered. If you look at infotech, is actually the second best sector in the past 20 days in terms of inflow. And then third and fourth, negligible real estate and energy, which also have been playing a little bit of defense. But I'm really interested that, consumer discretionary, because of Tesla and Amazon getting wrecked this past week, saw a lot of outflow the last 20 days. So you're going to see later in the sector rotational chart that this sector is actually ready for a bounce. And I'll get to that in a second. Okay, now, next thing here, your tactical sentiment, which was all the way in the green last week, with like for most of the week, right? It was here, is now in the middle again, right? Or just rightly, like almost offset the middle, right? So you're seeing a kind of a recovery, but not fully recovered yet, which means there is potential for their upside. That's just tactical, right? Short-term sentiment is all the way down here. So there is a possible for a snapback reversal, right? And then if you look at the Goldman positioning, this is a sentiment indicator, it's now breached into the downside, like the sold levels. So sure, the Z-score tells you the standard deviation, which is the riskiness. And that riskiness is starting to push into the downside here. The last time this happened was during the 2022-2023 bear market. But remember, this doesn't mean shit, because this could just be one piece of data, and then next week it just goes way up here again. So don't look at this as like a guiding factor. I'm just showing you that this just flipped right now, but it needs to hold there for a really long time for us to actually, have some kind of implication. Okay, this week you have, wait, no, next week you have CPI, right? Isn't it next week? I think. Yeah, it's next week.
Yep.
And then so just looking at the near-term catalysts here, March 3rd, you have ISM manufacturing, ISM services March 5th, PMI manufacturing February 21st, that's over. March 24th is the next one. Then your services 23, non-farm payroll, March 7 coming up this week. PCE deflator, March 28th, end of this month. Can't believe we're in March already. And then you have the Fed meeting March 19th, so 2 weeks from now, and then May 7th. So remember, April is going to be a non-Fed meet, and February also was a non-Fed meet. So you'll be having 2 months where the Fed is not going to meet. Okay. Some potential catalysts. China annual 2-session meeting March 5th. 30-day deadline for Trump Mexico tariff plan. That's going to happen this week, which is today, technically, for you guys tomorrow. Short-term spending bill. This is the thing we spoke about last week, which I told you guys in the next 2 weeks will become focus, right? It's the debt ceiling. That's happening March 14th. Okay. Trump call with President Xi to be announced. And then you have report back on tariffs on April 1st. So quite a fair bit to look at in terms of catalysts. You can read the report by Tony P on your own time. This I'm not going to go through it. Let's have a look at seasonality real quick. So composite for SPX flows. After March 13th, tends to see massive inflows. First half of March, first 2 weeks leading up to the FOMC event, tends to be sideways movement. We've already seen a big collapse leading up to March. So actually, this is where I think the sentiment will start to defer. We might see instead a relief of some of the pressures, gamma unwinding, and just general sense of people getting back into risk appetite, especially after the announcement from Trump about cryptos. Okay. Now, and for those of you that haven't heard about the announcement from Trump and cryptos, he basically said that the strategic fund is going to now have, he's thinking it's going to have Bitcoin, Ethereum, Solana, and a bunch of other shit, which obviously we don't know that's going to be real, or is it just something he's pulling out of his ass? But you know what? It's good for cryptos. I don't really care. Okay. Now, here you can see from a flow perspective, hedge funds activity on the desk slowed compared to last week while asset manager trading picked up. So this is where you can really see the desertion. You see the long onlys, LOs, finished 6 billion net sellers on the week, which is actually very interesting because they rarely sell. That's why they call it long only. And then while hedge funds finished light net buyers, okay. So you're gonna see in this week there's gonna be a significant amount of chase to the upside if this market starts running, because people will be underexposed. And look at the hedge fund equity exposure, right? Typically below the 0 is where they're kind of like short and very bearish, and then above 0.25 is where they kind of get stretched. And there's this like middle point where it's the sweet spot for them, and they haven't crossed over yet. So there's a possibility that hedge funds step in to clench some of that. And I hope that happens this week because that'll be really funny to watch after the market takes another dip if they want to really mess them up, right? And then apart from that, we get into the sector positioning. Okay, so really not that many opportunities here. I took a look at it. One of the ones that I do like is consumer discretionary, which is now oversold. You can see clearly oversold, right? Every time it's come down here, it's found a bounce. So this one's a very obvious buy signal right now. Biotech, I would ignore, right? Materials look like it's potentially heading downward, cooling off, right? Which makes sense because this was the most loved sector in the past 20 days. So then money has to rotate out of this into consumer discretionary or other sectors, right? Consumer staples is another one where we saw, when me and Andrew went through Coca-Cola, for example, during the course, and we told you guys as that's one of the opportunities. Look at what happened to Coca-Cola. Consumer staples now overbought, right? So this one is now going to experience some cooling. And once again, remember, this is a defensive sector, right? And this is also somewhat defensive, okay? So all the defensive ones are going to move into the aggressive ones, okay? Energy, stuck in the middle, not really made a move either way. Last week we were here, and this week we haven't made much progress. So I don't like this trade either. I will stay away from energy for the time being until I see a clear discersion of trend. Financials, this one has been cooling off for 1 or 2 weeks, right? Last week I spoke about potential financial short, and then it played out really nicely because the market dropped massively, right? And then actually, by the end of the week, we saw good strength in this sector. So consumer discretionary and financials are two of the sectors that I would like to buy the dip on this week. Okay. Now, if you want to know which of the stocks that are going to move within the sector, look up both of these ETFs and see which is the biggest holding in them. Really simple. Okay. Then you chart those opportunities and see if they work for your risk profile. It's really easy. Okay. Healthcare, ignore. Housing, approaching oversold levels, but not there yet. I think it has about a few more days to go. And then remember, FOMC is going to affect this one. Okay. So I would wait for this week to be over before we take a trade in this. Industrials also pull back significantly, has just a little bit more to go as well. So I will be waiting for housing and industrials to kind of play out a little bit more before I take anything in here. Oil producers I'll ignore since I'm ignoring energy in general. Mining I don't trade to begin with. REITs, holding pattern, right? So nothing really here. Okay. And finally, you have the most exciting ones. Retail. Retail firmly in the bounce zone now. Semis still squeezing, right? Still squeezing. Technology still squeezing. You can see it's very obvious, right? And then utilities, which I'm going to ignore because it's just been trading very flat. I don't really like the price action there. So semis and technology squeezing, consumer discretionary and financials bullish, and real estate and industrials with the potential bounce. That's your playbook for this week in terms of sectors. All right. Now let's very quickly jump into the technicals. So obviously everybody and their mother and cousins were calling for a crash last week, which if you were part of both groups, you would not have panicked. And you would probably realize that this was a great opportunity for you to pick up some of the things that you've been wanting to buy, some things on discount, right? We had 2 key levels last week we spoke about. The first of them was 6,000. The second was 595 on SPY. And the third was 590, right? We breached all 3 of them along the way somehow last week. And we validated majority of these points, right? So as we came down, we validated the support and then broke it at 592 or 591. And then we came all the way down to 590, right? Which was 5,900 on SPX roughly, right into the potential support, and then bounced out of it pretty strongly. This candle here with the close above the range was a pretty good candle, if you can see that. Let me zoom in so you can understand. On the 6-hour time frame, this is... Now, there's a reason why I use a 6-hour time frame sometimes. It's not just for hocus pocus or nonsense. It's just a more cleaner daily. That's all. You can see this 6-hour candle here specifically. Very nice pin bar that closed above the previous 2 here, right? So this is a pretty nice reversal candle. Now, the key thing here becomes if we're able to close over, first of all, 59.53. That's number one. And then the second of all, close above 60.33, okay? Which basically, essentially is 595 and 6,000, right? I think on SPY. I can double check that if you want. Yeah, basically, right? 595 and 600. You need to clear both of these levels, okay? So if you can get above this and bounce, then you're likely getting above this and then bouncing here. Then that's your, basically your leg up, right? So that's your upside scenario. What will be the downside scenario on this? The downside scenario is if you are not even able to close above 595, right? Or if you're not able to hold above 595. That means you just keep rejecting here, right? Or you went up to 600 and then you get rejected here with some double, triple top bullshit, something that happens here, right? Then leading further down. So that's possible. Another thing that's possible is you move sideways here for a little bit. That's also possible, right? So be aware of all of these scenarios. But you still want to play pivot by pivot here because remember, you are kind of moving in $5 increments on SPY right now, which is not too bad for a trading zone. If you're looking for risk to reward ratios, all you got to do is simple take it only at pivots, right? Whatever your bearish or bullish scenario. So that's my 2 cents on the technicals here. On NASDAQ, a little weaker than the counterpart, in my opinion. We're seeing mostly SPX is the one that's leading, and that's because of the strength in financials, right? Okay. So then we have a couple of things I wanted to discuss was SOXL. This one got really smacked last week below this point. It's been holding for a little while. But I think this week, if it can, if semis can squeeze, then you'll see that this has the potential to become a liquidity engineering sweep. However, it's not there yet. Remember that. So it could continue going further down. But right now, if we are able to reclaim 2653 somehow by, the next 2 sessions or so, then this becomes a sweep. Okay. Right now, it's not a sweep. Right now, it's still just a breakdown. And remember, if it comes back up here to reject this area, then semis are going even further down. Okay. So remember that. If it's able to break 2653, close above 2653, then this becomes a bounce zone for upside. Okay. So that's your line in sand for semis. Apple, very nice buyback last week. This is on my radar for this week again. Very beautiful bounce on 230. This was a key level we were watching. In fact, last week's plan for Apple, both of them played out. It's very rare that this happens, but both of the plans played out. It first came down to create liquidity at 241 pre-market, and then rallied up to 250, rejected, came all the way down, rejected 242, and then came all the way down to 230. So this was a beautiful one last week if you did play the plan. With Microsoft, I think Andrew posted a chart for this one, but on the daily, you can see this has been significant level of support. And now it's bouncing off that same support. For those of you that have never added shares of Microsoft to your portfolio, this is where you want to add some. Okay. If you don't own any, just saying. And then this can become a potential bounce zone, but remember, it has to really, really reclaim like 420, almost, right? For it to really have a bullish reversal. Otherwise, it's going to be ranging for a little while. And yeah, and Tesla, right? Tesla with a decent daily close. Decent, but not the best. Bounced off the 38.2, 23.6 area, which actually it should have come down all the way down to 269, 270, but it just came shy of that. Which, to say sometimes obviously these things are not perfect, but came pretty close down to 273, so I'll take it. This is a good area if you haven't added shares once again, right? And the last one is NVIDIA. Came down to my position to average price, came down to intrinsic value. If you haven't added this to your long-term portfolio, please, I don't know how many times we would have to tell you about this, but good stock to own long-term. And yeah, that's all I have in terms of my spiel here. And yeah, I'll hand it off to Andrew.
All right, let's get into the nitty-gritty stuff. So, if we look back at last week, right? This was last week's plan. We essentially knew that there was two key levels, one being 600, right? We knew that there was selling pressure below 600, and as long as we stayed below 600, there was no upside, right? We're just going to keep it pretty simple in the recap section. So we knew that below 600, there was no upside. If we go look at the market, right? And we look at last week, go here into the 4 hour here. Just turn everything off for now. Okay. If we look at last week, we can see that at no point did price break back over 600, right? So what that would tell us is that the selling pressure that the market makers were essentially holding price below 600. Therefore, the selling pressure kicked in, pushing price down into the 590 area, where again, we broke, and then we had this nice quick sell-off into the downside, approaching this 584 area. So that brings us to this week, right? And when we push down last week, we can see here in the dark pool print that there was a large print, right? So here we had a 3.6 billion at around 585. And then on Friday, we had a 2 billion at around 593.37, right? And so the way we use dark pool is pretty easily, right? If price stays above it, then, we look at it from a bullish standpoint. If price breaks below it, then we look at it from a bearish standpoint, right? So that brings us into what could we expect this week. So I'll just read it to you guys, right? Last week, we spotted over 32 million in sold puts, which I'll show you guys in a second, at a strike of 600. This position in relationship with the dealer environment is what forced market makers to sell shares short, creating a selling frenzy as price targeted the downside move. Once we broke 590, that added more pain for market makers, creating the volatility we all saw this week. As you can see from the image, we have found some support on the dark pool at 9.3 billion. If price can hold over 590, we'll be looking for a push into 600, and a break of 600 would kill both selling pressure from both major levels, forcing dealers to be able to just ride their positions into the upside towards the golden pocket. So essentially for the upside, you're looking for price to get over 600. If price gets over 600, then you're watching for the market to just melt into the upside, right? If price breaks below 590, then that selling pressure can re-engage. So if we take a look at some of the data for this week, we can see a few things, right? One, if we're looking at the algorithms, we can see here that on Friday, SBX did have some bearish positioning down here around the 5860 to 5840 area. Okay, so that's the first thing you probably want to take note of. If you look at the overall week, it's very bullish from a SPY standpoint as well as an SPX standpoint. So when the price was down here, we were getting pretty bullish because we could see that positioning had gone bullish, targeting this 60-40 to 60-50 area, which I'll show you what that is. So you can see here that this is a liquidity sweep, right? You have an established low, you then sweep that low before you make your big move. Therefore, you can stop everybody out, collect all those positions for yourself, and then ride the positions to the upside. So we do still have some upside here into this kind of 60-50 area. So the question is, are we going to retrace first and then go up? Or are we just going to go up, right? So those are the first things that we're looking at. Then if we take a look at the NAMO, we can see that the NAMO almost got oversold. Not quite, but it got pretty close. And the short term was oversold. So we were looking for a bounce, which is what we saw into close on Friday. So from a risk to reward standpoint, we like that. NASI still kind of bearish, but that's more longer term. If we look at seasonality in line with what T just talked about, early March is usually pretty sideways or slightly down, with the back end of March showing bullish activity, moving into a bullish April. Okay. So essentially going into, this is probably your quarterly expiration, right? Or I think the 19th he said was the FOMC meeting, right? So seeing some downside here into kind of early mid-March, and then we're looking for a very bullish move coming out of March into April. And if you take a look at the chart, it's almost identical, right? You have a liquidity sweep. You have a pullback here into February. And so now you're at this point, right? Do you bounce here and go for an all-time high, right? So far, the year is starting off exactly as expected. So that brings us into fear and greed. And you can see here that the market is very scared right now. So these are areas where you look for opportunities in stocks that provide the best risk to reward. So what do we want to see? Well, right now, dealers are positive deltas, which means that they are selling shares, right? So Their deltas rise, they sell. Their deltas increase, they sell. So in order for you to see in a reversal towards all-time highs, you want to see those deltas flip into the negative, which then would force dealers to start to buy, right? So that's what you're looking for going into this week is the environment going to change for the market maker, therefore creating a buy the dip situation versus a sell the rally. Now, the two levels that you want to be paying attention to are 590 and 600, okay? So right now, the dealers are long 600 and they're long 590, right? We know this because we can actually go in and see the position that happened, right? If we go in and we look at the open interest, we go here to puts and we go to March 21st, right here, and we go to 600. Oops, there it is. $32 million in sold puts at 600, which forces market makers to now be long 600. Therefore, they want the price over 600 by March 21st. If the price is over 600 by March 21st, they collect $32 million, right? That's the basis to understand that position, right? There's other levels to the position, but that's essentially what you're looking at when you see that massive amount of dealer exposure at these levels. So the only two levels that I'm really paying attention to this week are 600 and 590. If that changes, then I'll update. But as it stands right now, those are the two levels. So now that we know that, we can now look at the chart. If we look at the chart, very similar to what T had, right? This is the top of our wave. This is the bottom of our wave. This is your liquidity sweep, right? Breaking above, reestablishing below, and there's your sell-off, right? And where does it bounce? It bounces right in the golden pocket. Okay, that's where we look for opportunity. So if we're looking at this week, there's a few different scenarios that we could see play out, right? If we say that this is the low and this is the high, then we're looking for a retrace to the golden pocket, right? So that's the low, that's the high. This would be our golden pocket. What would happen to get there? Well, we are already above 590. So above 590, you kill that selling pressure. If price can either come down and bounce off this or comes all the way back down into the golden pocket and then retakes 590, we're looking for that move up into 600. And if we break 600, right, all the selling pressure is now gone. We're looking for that push up into the golden pocket and the weekly move, which is at 606.45, right? If we break over the golden pocket, then we can go all the way up into the high, which would put us back at all-time highs and into this bearish order block, okay? So that's one thing that we'd be looking at. Now, if let's say the SPX algorithm, which on Friday was pretty bearish, showing potential downside, we'd be watching for a rejection here off of this dark pool level, which is about $4 billion, and a retrace back down into this golden pocket area. Maybe a liquidity sweep, right? Maybe we come down and sweep the lows and go down here and hit the weekly move and then bounce and look for a move to the upside. So that would be the other thing. So essentially, what would you be looking at there? Well, if price gets below 590, then that selling pressure re-engages, right? And now you have selling pressure from two different levels where dealers have to sell share short, which could push price back down into this 584-ish area. And if you break the golden pocket, which is here, you could essentially come all the way down into the low, which would be down here. Okay. So those are things that you need to be paying attention to if you're looking for opportunities this week. 590 and 600 are going to be the key areas that I'm going to be watching for opportunities, right? So break below, candles are closing below 590, looking for downside. If candles start holding and closing above 590, I'm looking for a push up to 600. If we break 600, I'm looking for the weekly move, which would be about that 606.45 area. Okay. So those are the key things that you want to be watching for if you're looking for opportunities. As you can see right now, that dark pool print right here is holding as support, right? That level is $9.3 billion, right? And so right now that's holding. And if that breaks, then you've got a $16 billion level right here, right? So you'd watch for that to hold next. So as it stands right now, as long as we're above 590, I'm okay. If we break below 590, then I'll start to readjust. So with that, I will now open it up to you guys and your questions, as we got about 30 minutes to work through stuff. I heard somebody say DBX, so I'll go to that first.
I'm going to go ahead and stop the recording right here.
Sounds good, man. So DBX, oof. It's going to a longer time frame.